Of T3 Trading Group, which is an SEC registered broker dealer and member of FINRA. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. And there is the position disclosure. It's the same as it was at the end of last week. All right, cool beans. Just give me a moment, if you guys don't mind. I had one stock here reporting earnings after hours, and I had this other stock get upgraded, so that's good. They're both moving in my favor. Everybody gets lucky sometimes, but just trying to manage it while preparing for the morning meeting at the same time. Sorry, morning meeting, I mean afternoon meeting. Almost ready. Almost ready. Okay, let's dive in. All right, so the market is down small from where we closed, and with that, we're basically flat. The Qs here are down 90 cents from where they closed, and including that, they are also, flat down small. And the Russell did finish green. The Russell had a lot of relative strength early on in the day in the morning, and then that faded midday with everything. TLT had a positive day. That's great. We definitely want that. We don't want a credit crisis or a bond crisis or anything like that. And the dollar is continuing its downward trajectory, so still concerning what the dollar is doing, down 0.7%. Okay, let's have a look at this market. So, I mean, today was a pretty impressive day. This is a really impressive day. So, this morning we gapped up, and it was a day 5 to the upside at, extreme extension. I know our range of extreme extension has expanded because the market's been so volatile and moving so crazy, but we were still at extreme extension this morning into that day 5. Last week, an incredible week from low to highs. Monday's low, which was the only negative day last week, was 508 spot 50 in the SPYs. We closed on Friday at almost 551. I mean, basically a $43 up move in the SPYs from Monday's low to Friday's close is really, really incredible. It also brought the market in a very short period of time from extreme downside extension, which is where we were on Monday, to starting to get into that extreme upside extension zone into the close on Friday. As of Friday's close, we were trading at like $14 or so of extension, and then today was similar at highs. That opening high from when we initially shot up in the beginning of the day, we were about $13.50 of upside extension. So, in a normal market, I characterize anything as, for the SPYs or Qs specifically, $10 away from the ADMA on the daily as extreme extension. With the amount of volatility we've had, maybe it more means like 15 to 20. But all the same, $13 of extension at highs today is pretty serious when you consider that it was a day 5, and also short-term tactical was opening in the red zone. Which, just to repeat what I always say, short-term tactical in the red zone does not in and of itself mean to short the market. It more means don't buy. So on top of it meaning don't buy, we got a small time frame signal to short, which was great. When we shot up here on this third 5-minute bar of the day off the ADMA on the 5, and this is why it's so important, by the way, to be looking at the market in multiple time frames, right? Because if you just were only looking at a 5-minute chart of the SPYs, you'd be like, oh, this is really bullish. We had a gap up. We had a little bit of a technical correction to the ADMA on the 5. We created a pivot low. We're boosting off that. We're getting ready for continuation. But when you think about the potential of this continuation on the 5-minute chart within the confines of day 5 to the upside, short-term tactical in the red, $13 of extension or wherever we were exactly at that point, all of a sudden you understand that this small time frame pattern, which maybe looks like a continuation pattern, is not really something you want to be buying. And in fact, those other factors I just discussed on the bigger time frame mean you could keep an eye out for a short. And when we got this little pivot high here at 9:45 and came back through the high of this really bullish 5-minute Maribozu, that led to me calling out the short. And then the game plan off that short was, look, get your risk covered. Get the risk covered for sure. Any of these counter trend trades, you want to get your risk covered quickly. Probably book some additional profit beyond that into this 8 and 21 EMA area. So that way, if we just went to, I don't know, this low here at 9:55 and bounced right back up and made new highs on the day, you're going to make money in the trade no matter what. But also keep some in case we get a little bit of a bigger move based on the daily chart. The daily chart at EMA, again, is all the way down to 540. It's not impossible for us, especially at such a big resistance area around 550, to price correct all the way down to 540. And that's $13 worth of price correction as a possibility just to the ADMA on the daily off of really small time frame risk on the upside. So we broke lower, we pivoted back up. I remember being on the radio and us trading around this like 550, 150-ish area and being like, wow, it's interesting. We're trading, somewhere really more at the Qs and the SPYs. We're trading somewhere in the midpoint between the low of the day and the high of the day, this pivot low and this pivot high. We had a bunch of little false starts in both directions. Market was really trying to hold the key 550 level. 550, just that huge daily chart level that was support pre-retaliation tariff announcement, has been resistance post retaliatory tariff announcement. So again, now we're actually trying to hold that as support in the beginning of the day. And then finally, we broke lower out of this consolidation with the Qs actually showing some relative weakness to give us a potential deeper price correction. So again, you still have a short from highs. You could have had that with very low risk. You took some off for sure. Great idea. Maybe continue to book some a little bit on the way down. And then we kind of made like a little bit of a sideways double bottom where we broke up, and being completely honest, the degree of strength in this bounce in the afternoon here took me by surprise. Now, I still am, if we go over to the big picture, kind of describing myself as a smaller time frame, maybe even intermediate time frame, daily chart, kind of more macro bull within the confines of being like a really big picture bear. But really big picture can be so far out that you've got to be really flexible in terms of the thought process because information changes, the technicals change, and you have to be able to adjust. But for the moment, we have been discussing, and I think we saw some of it last week, and we could easily continue to see it this week and even through the beginning of May. I think that there is a lot of positioning risk to the upside. I've been talking about this for a couple weeks. We really saw it come to play last week, and it can continue. It just doesn't seem to me like market participants are prepared for upside risk in the same way as they are for downside risk. You can see that in the option skew with how people have been hedged with all the hecticness that's been going on. But you also now see the positioning risk coming in the form of the CTAs, which were buyers in every tape last week and continue to be buyers in every tape this week to the tune of, just for into the United States, into SPX, in an up tape, in a flat tape, they're about $7 billion worth of a buyer. So similar to last week, it's actually even stronger than last week. So in an up tape, $7 billion worth of buying, that means that they're going to be buying a little bit more than $1 billion worth of stock every day into a flat tape. Into an up tape, it can feed on itself further. $12.5 billion to buy from CTAs this week in U.S. markets into an up tape. So that's pretty decent. That's working towards a couple $1 billion a day, and then and even in a down tape, they're buyers $4 billion in a down tape. So you almost even have $1 billion a day of buying even in a down tape right now. So the systematic flow from the CTAs, that risk continues to be to the upside. They're buyers. At a minimum, they're cushioning down moves. We know that soon vol control, if we can get some tighter realized vol days, soon vol control can become a buyer as well. And finally, we are exiting the buyback blackout window from earnings. And we also have an update here. This is from Goldman, I believe. We estimate we are now in an open window buyback period. That's as of last Friday, which is estimated to run through June 13th. As of now, we estimate 40% of companies are in the open window where they can now be buying back stock again, and 65% will be in the open window by the end of the week. So as we get through earnings reports, and this is a really, really big week for earnings names, as we get through earnings reports, these companies can begin buying back their stock. And that, again, provides just an underlying bid to the market. So I've really, really learned personally with my own trading over the course of the last handful of years as I started to learn more about these strategies and flows in the market. I've really learned, don't fight the flow. It's just so important. Don't fight the flow. We got CTAs buying. We got vol control that's going to be buying soon. We've got buybacks that are coming back into the market. Can that get overwhelmed by hedge funds, by long onlys, by retail? Absolutely, it can get overwhelmed. But it's just a big difference in these market dynamics compared to, for example, this first wave where we broke down 10% from all-time highs and entered into a market correction, where it was the opposite. It was CTAs were not only not supporting the market, they were heavy sellers. Vol control was becoming more and more of a seller as the movements increased, and we were going into the buyback blackout window. So I've really learned, again, just to repeat myself over the years, don't fight the flow. It can be overwhelmed, so pay attention to the size of it, but everything else held equal, there's a lot of underlying support to this market. We saw it last week, and it can and should continue this week into next week. And all that buying is also happening in a tape that has lower liquidity. So it means that it has an even larger effect on the market than it would otherwise. And you can take all your rationale and all your reasoning for why we should be lower, tariffs, economic slowdown, yada, yada, yada. Believe me, I'm on board with some of those bigger picture thought processes on why economic growth can slow down, earnings reports can weaken out, the unemployment numbers can increase, inflation can increase. I'm on board with that conceptually, but what I'm seeing right now from this market is a really strong underlying bid. I mean, even today, I know Pat was saying he actually felt like the degree of the down move was like more than he expected. I almost felt different. I mean, I do feel a little bit different than that. The ADMA is all the way down at 540 when we just went from 508.50 to 513.50 in 4 days in a morning. That's such a big move to the upside. I would expect some technical backing and filling here, but then you just see that underlying bid comes right back into the market. It cushions the downside. It helps accelerate us to the upside. Now, we do still have enough extension to the upside here into this really big 550 level that I'm not, as I'm saying, don't fight the flow and recognize the CTA flow and the buybacks are coming back online and the vol control funds might come back online. And I have been calling for a couple weeks now, even when we were trading at 510, like back here on April 10th, that a positioning squeeze, this is off the information that I'm going over right now, to between 560 and 570, or even the 200-day at 573, it's not impossible at all. We always want to think about this type of stuff, though, within the confines of extension as well, right? So now we're And this is, by the way, what makes trading so difficult and so dynamic, and also for me, at least, so fun and exciting, is that there are just so many counter things happening at the same time that we have to be able to understand and rationalize and help to develop a thesis around for our trading, where it's like, all right, really really big picture, we've got the potential of a growth slowdown, an unemployment pickup, an inflation increase that could be bearish on the really, really big picture. But on a bit of a smaller picture, but also on the daily chart, I've got all this flow information that is actually pretty darn bullish right now. That says we could have a positioning squeeze to 573. But on an even smaller picture on an intraday, when I see the market on day 5 to the upside with $14 of extension and creating a pivot high, I can look to short. So I can look to want to be short based off of my extension rules, short-term tactical red, day 5 to the upside on a time frame that's basically intraday, while I wait for the market to set up on the smaller picture daily chart to give a potential positioning squeeze to 573, while at the same time I can also be really big picture having a bearish thought process on just, hey, I really expect at some point we're going to start seeing a creep in on the economic numbers, on the fact that the shipping charts that we saw from Apollo pre-market this morning that show that stuff is just completely dropping off, and we're potentially rolling into a supply chain economic issue that is as bad as anything we've almost ever seen outside of maybe the COVID period. So it's like time frames are just so important, and figuring out, what time frame do I trade on? What time frame is my edge on? How do I want to position myself around the fact that this morning is not the day to buy stock by any means, and potentially is an opportunity for short-term shorts, but I actually want to have long exposure because we could get to 573, but also I want to be cognizant of the fact that I probably need to have some short exposure as well, or to reduce those longs on the way up when we've got like a bigger picture thundercloud overhead. So that's just kind of where we're at on different time frames. It's a lot to digest, it's a lot to figure out, but that's why doing your morning research every single day and getting started early, and trying to come up with this thesis that's confirmed by the technicals, and then figuring out a game plan to confirm a game plan to trade the thesis that is being confirmed by the technicals. That's what you kind of need to do on a day-to-day basis in order to really maximize your P&L, because I still think the bottom line is that the biggest P&L comes from capturing big moves on big size. And sometimes the market doesn't give you that. Sometimes the market just gives you the short opportunity from a day trade like we had off the open this morning. But on other circumstances, I still remember when we were buying at 490 and below 490. Heck, I remember now actually on the day of the low of the day, us saying you could buy like 483 in the SPYs, or that equivalent in the indexes. And I'm pretty sure I remember saying on that day we could see 550 on a oversold bounce to retest this level. And we identified on that day like a small time frame execution on the 5-minute chart, and we were saying book some profit to cover your risk. I don't care, just to repeat what I said a few weeks ago, I don't care if you bought SPY 483 and you sold some stock at 484.50. I think it's a great job. And if you look at yourself at SPY 550 and you're mad that you sold stock at 484.50, that's the wrong way to think. Because trading is as much art as it is science. We can identify areas where there's a higher probability of us beginning to move higher, or a higher probability of us beginning to move lower, but you never know with absolute certainty. So if you bought 483 in a market that was getting absolutely smoked, and you sold stock at 484.50 to cover risk, that's a great job. If you sold more stock at 492 because of a 15-minute moving average, that's a great job. But what we were saying then was, book profit to cover, book some to cover risk, book a little bit more in important moving averages just to make sure that if the trade fails, you're going to make money, and hold some in case this smaller picture move turns into a bigger picture move. And to some degree, though I don't think it was nearly as extreme or nearly with the same reward profile as that long back on April 7th, to some degree, we were saying the same thing this morning on this short. Get your risk covered. Book a little bit more at the moving averages. But hey, guess what? Be greedy on some in case we lose 550, in case we give a deeper price correction down to the ADMA on the daily, which is 540. And that, breakdown of all of the information on multiple time frames, but then putting it into a game plan that's based on the technicals as they confirm them is how you really minimize risk and maximize reward. And that's what we need to be doing as traders every single day. So if you sold some stock today at 552 and then we went to 545, that's a good job. If you had stock at 545 short and you gave it all the way back to 551, that's not necessarily a bad job. If that's what your game plan called for, because you had at that point, I don't know, 10 to 25% of your position left, and you were being greedy and maybe implementing some sort of a trailing strategy to see what sort of downside continuation you get. And look, it's still not impossible, even though I think that the positioning risk is still to the upside, it's still not impossible for a pullback to 540 to give way to a pullback to 525 and give the gap fill from at some point last week. So that's, I guess, pretty much all I've got on my side to kind of break it down on an index level, because I think that the indexes right now are key. We got to start at the index level before we break down to individual stocks. With that said, we are in earnings season, and you can certainly be focusing on some individual stocks that will trade with a lower correlation to the market as a whole because of everything that's going on. So that's all I got. I'm happy to answer any questions that you guys may have. I think the first thing I'm seeing here is from Dave S. One thing that I am personally still struggling with is the early morning false moves, such as the 5-minute candles at 10, 10:30, 10:40 in SPY. 10, 10:30, and 10:40. Would love to see more days where we don't range out the first hour of the day before picking a direction to go in. Unsure if there's much to even do about the market wicking around like that. I hopped into the sell-off today a little bit later than was probably appropriate due to being wary if it is happening again. Sure. So the first thing I would say is that if you had good shorts on from when we initially called them out at highs, and you had your risk covered, and you booked a little bit more than that, this stuff I would describe as annoying, but inconsequential. You got your stop loss at highs, you're patiently waiting to see how the rest of the game plan plays out. Whatever profit you wanted to book between from where you shorted on the call out to that low is already booked. And at this point, you're waiting to see, all right, do we break back up and I get stopped out of what I have left, or do we break down and I can potentially make more money? So the noise here, while again annoying, I was looking for further downside follow through, and I remember noting this pop up, but then being happy by the pullback, and then being annoyed by the fact that we held 550, and then being happy when we broke below 550. I wasn't really going through those emotions to that degree, but I'm trying to describe how it can feel to a trader in that situation. I would say that all that's actually noise. Now, if you didn't have any positions on because you missed this high and you're looking for the execution, then the noise is a real struggle, because the noise can lead to false signals that you're executing off of, where one of the most annoying things in trading can happen to you. Your idea works, but you get shaken out, or your idea works and you lose money. Like, if I totally could see someone on this 10:30 candle going, all right, We tailed through 550, but it was a big move down, so we held it. We're going through 550 again. This is it. I gotta lean in. We're gonna lose 550. We've got a lot of extension on the daily. I want to lean in on the short, and then you get the bounce back. And luckily that bounce back never broke the last pivot high, so you probably didn't get shaken out if you're using the right stop loss. But it's still frustrating, and this is also, by the way, why it's so important to follow a game plan. Because if you don't have a good game plan in place, let's say you shorted 550 at 1030, the right game plan, the right stop loss, in my opinion, is the 1020 pivot high. But if you shorted at 1030, this is what we do as traders. We short at 550. It tails back up. You start saying to yourself, oh my God, I can't believe they suckered me in on the short just for us to get this bullish looking downside tail. They held support. I know I'm going to get stopped out. I know I'm going to take this loss. Oh my God, I can't believe I'm going to, I've been there, and that's how I'm able to say this. I'm pulling my hair out. I can't believe I'm about to lose money. I thought this was such a great signal. And then you just freak out and you pull out of the position early, and then the actual stop holds, and then the trade eventually works. So game planning is so important. Buy the ticket, take the ride. Markets don't work perfect in terms of execution all the time. Sometimes you get false signals. Sometimes you get shaken out. But it's always about doing things consistently right in the long run. So I hope that helps Dave. From Greg, seems to me that known unknown market headline risk is to the downside now. For example, a weak payroll, bad earnings guidance, any weak numbers, while unknown risk seems up. For example, tariff deals and softening. But generally, I view the headline risk as balanced or maybe into the downside, where I've been trading like those risks were to the upside. Sure, so it's a great statement there. I have been describing the headline risks to the upside for a couple weeks now, but really what I've been referencing when I've been saying that is tariff-related headlines and deals and softening and things like that. And you're also describing and seemingly agreeing with me that for the moment at least, I do think that there's a potential where this changes, but for the moment at least, that risk is to the upside. But the economic numbers, I agree with you. I think that the economic numbers as they come out this week, and we're going to get some decently important numbers this week. We did not have many last week. I think that good news is good news and bad news is bad news. And I think that you're actually probably right, where for like a bad jobs number maybe, or any really weak numbers, in those situations, it might actually be a larger reaction to the downside compared to the upside. But we'll see as the week progresses. So I appreciate the commentary there, Greg. Not seeing anything else in the VTF. Seen a lot of commentary on the YouTube, so I'll pop over to that. From Robert, I used to get caught on these rapid moves like today at 940, the 940 candle. Okay, that upside move. Fast move, I thought, is a signal for strong buyers, and I tried to always play a pullback to the long side, and I'd get stopped out. Now looking at those strong candles, I'm staying away and waiting for the next signal. Does it mean for you those strong candles are liquid and price have to come back to buying zones or totally reset and give a new signal? And I'm not talking about breakout candles. It's a different story. Also going back to my volume analysis. Oh, let me stop you there. So I went over this a little bit, but I think it bears worth repeating. It was kind of the first thing I said in the afternoon meeting today. This in and of itself, if you're just looking at a 5-minute chart, is very bullish. It's a very bullish signal. That's why you can't just look at 5-minute charts. You can't just look at a 5-minute chart in the vacuum. For me, the most important chart is the daily chart. And then after that, probably the 5-minute, honestly, from an execution perspective, and then the 15-minute. But I agree with your analysis that this is great buying signal. We digested the gap up. You got a nice pivot low. and then you get this real nice move higher here, and then you're saying to yourself, maybe I could be buying this for momentum, or maybe I should be looking to buy a flag pattern or buy a pullback or something like that. Analyzing the 5-minute chart price action here, I totally agree. When I look at the daily chart, I suddenly have zero interest in buying this chart because the daily chart is telling me everything I need to know about not buying this market on a day 5 to the upside with $13 worth of extension and short-term tactical in the red. Your probability of success in trading on a small time frame is based off the message that the market is giving to you on the daily chart. That's just so key in trading. So again, in a normal, if the daily chart was looking bullish and I got this pattern, 100% how are we buying it? But with where the daily chart was, not only am I not buying this, I'm calling out a short up here. And that's the key difference. On to the next part of your question and commentary. Going back to my volume analysis, if you look at the 940 volume candle versus the 950 volume candle, there's higher volume on the 940. If you just compare those, 950 is showing bigger sell volume. Is it though? It's not what I see on my chart here. I see the 950 candle is the lowest volume 5-minute bar of the day. So big picture and line daily extension. Yep, for sure on that last bit. 945. Okay, yeah. Yeah, so, yeah, I mean, maybe. I think that so actually, no, I guess I agree with you. So when you have a doji on higher volume, I think that's a signal for the other way. And I think that's what you're saying as well. So, yeah, same thought process on that. From Formula One, I'm scaling into a Bitcoin short as these highs are diverging on the 4-hour chart. I don't have a 4-hour chart, so I can't look at that. How would you best try to execute that for a move down to the mid 80 to low 90,000 area? I need you to tell me what that price is on iBit because I can't pull up spot Bitcoin on my light speed here. We are also in a big weekly bearish order block. I am thinking to slowly piece in with a stop above that order block at 99,500. Sure. So, not really sure because I don't have like a spot Bitcoin ETF. I've been getting a lot of questions on Bitcoin, just spot Bitcoin ability to trade or chart. But I've been getting a lot of questions on Bitcoin recently, and honestly, for me right now, it's a complete avoid. I get what you're saying and I get what you're doing, and I don't disagree with it, but for me, it's a trade I don't want to be involved in right now. I have been a overall pretty big bear on crypto. I think everyone knows that, but I am always open to changing my mind as new evidence presents itself. And a couple things here. One, it's been trading great. It's been trading really bullish, really strong. It's gotten above this $50 level area that was important. There was another resistance level here at 52 that was important. More importantly, what's given me pause on reshorting Bitcoin, and I'm going to say pause, and I'm not necessarily switching to be a bull either by any means, but I'm taking pause on being as bearish as I was previously, is that we had a couple of days here in the confines of this up move where the NASDAQ got smoked and Bitcoin was green. So that's the first time, and again, it's only been 2 trading sessions, so I don't want to overly read into it. But my bear thesis on Bitcoin for a long time is that it's useless. It's not a currency. I can't buy stuff with it. It had not been a store of value. It basically just moved like high beta NASDAQ is what I saw from all the price action I've been seeing in Bitcoin for a long time. And all of a sudden, we had a couple trading sessions here recently where you could have made an argument that Bitcoin is acting as digital gold. And I have to recognize that as a trader who needs to be able to be flexible mentally with a thought process. We saw that happen on 2 really important trading sessions in relatively recent history in combination with a lot of relative strength. So for me personally, I'm not ready to be a Bitcoin bull. I'm not ready to buy it. It's still underperforming actual gold into the gold move that we've had recently. But I've taken pause on shorting it just with the strength. With that said, kind of understand your thought process and what you're doing. I don't disagree with it, but I also just wanted to explain to you why I'm avoiding. And I guess you're looking at like 56.20 as like a stop loss area. Yeah, sure. It looks like this high here from February 21st is like a really important resistance zone for this high bit that you could pay attention to. So thanks for the information and the question, Formula One. Back over to the YouTube, the VTF. Pete's asking me about Apple. Like I said with Greta today, at this point, I'm really waiting for the earnings reports for these names. I'm not in a rush to trade them this close to the earnings report. So I think Apple is Wednesday after the close. There's nothing for me to do really here until the report. So I think 210 is a really important level. You want to note that level. We closed right at it. I think you want to note it for where we are after the earnings report. Is Apple above or below 210 after it reports? Is Amazon above or below 190 after it reports? Is Meta's the one that I think is much further away, above or below 580 after it reports? Is Microsoft above or below 395 after reports? Those are the key levels I'd be paying attention to after the report. And prior to the report, I'm not doing anything with them at this point. I don't know, I have a strong opinion. Thank you, Dave. Dave gave me a chart of Bitcoin on the 4 hour. It's been strong. It's Dave S. From David L. You sometimes mention that you're down to a core position after adding and subtracting some size. Usually what I mean by that, before I read the rest of your question, is sometimes I have more than one trade going on in the stock at the same time. So for example, in Palantir, I have a swing position on, that's a short, and that short, even though I've actually called this out as a long, is on to offset my longs that I have in my swing portfolio. At the same time today, I called out a couple pretty good Palantir shorts that I took as day trades. The short at the high, and then the short versus this pivot high. So what I meant when I said with Palantir today, I'm all out of my day trade short and back to my core, is basically I'm back to just the swing position. It doesn't necessarily mean, I feel like a core might imply that it's small. It doesn't necessarily mean that I'm back to a small position. It just means that I had two trades ongoing at once. One was a day trade, one is a swing position. The swing position, the day trade I am now entirely out of, and I'm just back to the normal swing position that I'm on. Are you basing your core positions off of a certain position size or off of an entry price? There you go. I think I answered your question. So thank you, David L., for the question. From Eli, just out of curiosity, do you ever weigh out probability versus risk reward? Every trade I take is weighing out probability versus risk reward. That's the whole key to trading. Trading is risk reward, probability of success. You can risk one to make one and be right 55% of the time and be super, super, super rich. You can risk one to make 5 and be right 25% of the time and be really wealthy as well. So it's all about probability of success versus risk reward on every trade that you take. That's the core of this. A risk reward is relatively simple math, generally speaking. Where are you entering versus where is your stop loss? Probability of success is, I don't want to say it's more important, but because it's harder to assess, it in some ways makes it more important. Probability of success is harder to assess because it's so dynamic. There's just so many influencing factors on probability for every trade that you take. I have a probability class in my training program that might be worth a rewatch. The feedback I get is it is one of the best classes within my training program that I have. But it gets into a lot of the more ubiquitous layers of probability, market, time frame continuity, relative strength, time of day, etc. But there's also all these one-offs, large order option flow, extension, things like that. So I hope that helps. From David L with the follow-up question. So you're trading in? No, I do it in the same. The question is, are you doing it in different accounts? No, I'm doing it in the same account. But I don't know what the right way to say this is. I'm advanced enough as a trader to be able to juggle two positions at the same time. I can understand that I have a 10,000 share position on as a Palantir swing and a 4,200 share position on as a Palantir day trade, and I have two different game plans. So I've got different bids and offers out for those game plans. And I know that if I get filled at, and again, this is systematizing a game plan, which I think is really important for trading. I knew when I was trading Palantir today that if I was getting filled 100 shares at 76, 51, 26, or 01, that was related to my swing position. And if I was getting filled 500 shares or 200 shares at 50, at 89, at 69, at 49, at 29, at 09, at 89 down, that was related to the day trade. And I just know that. I inherently just know that because I know my game plans so well that I am able to manage two trades in the same position at the same time. Now, one thing, if it's the same symbol, they both have to be trades that are in the same direction. I can't be short Palantir as a swing trade and long it as a day trade at the same time in PLTR. I could use, if I wanted to, a levered ETF. If I wanted to be short Palantir on a swing basis, but long Palantir on a day trade, I could be short PLTR and long PLTU at the same time. That's something I could do. But otherwise, if it's the same symbol, I have to be able to mentally separate those game plans. So thanks for the question, David L. All right, gang, working towards 5 o'clock. I think I got through all the questions. It's Monday. It was another crazy one. Huge ranges again today, even if we didn't close up or down by very much. We actually had a tight realized vol day today, so that actually further enables our underlying bid in this market from the systematics to come into play. But we still actually had very large ranges. SPY from 553.50 down to SPY 545, $8.50 down just to bounce $7 up off that. Very large ranges, but low closing realized vol. So that actually is bullish. Have a great night, everybody. I'll see you all tomorrow.